Welcome to Manufacturing Talk Radio.
Good morning, all. This is Lou Weiss with Manufacturing Talk Radio, and I'm here with Tim Fiore from the Institute of Supply Management, reporting on the July 2023 excuse me, Manufacturing ISM report on business. Thanks for joining us.
Yeah, thanks for having me, Lou.
How you doing?
Good. I was really happy to receive this report a couple of days ago. I mean, we've been predicting that we were in an adjustment period back in May and June. And, it's really hard to make predictions on 1 month or 2 months worth of data. But the month of July really cemented the expectation that, okay, with the fact that demand has been weak for so long and we've been working off of backlog for so long, people need to take some action to reflect the fact that half two is going to be weaker than half one. And that action is primarily going to be focused around labor. And sure enough, we saw that. We saw the production number, which is a surrogate for revenue. We saw that come down again, not as much as June, but it came down again. More importantly, we saw the employment number come down to 44. So people are taking steps to reduce headcount. A lot of the comments, I've been tracking employment comments now for several years. The three things I look at from a force management standpoint are layoff comments, attriting down comments, and freezing comments. And the month of July, about all three of those elements were about equal, which had been the case all the way up until June. In the month of June, layoffs became more prevalent than the other two historically. But in the month of July, they returned. So the reason I'm bringing that up is that there were a lot of comments here around we're attriting down. As people quit, we're not replacing them, and that we have hiring freezes in place. So if you want to hire somebody, you can't. And at the same time, the layoff comments continued at the same kind of quantity that we have seen in the past, but on a percent basis, it kind of normalized out. So the panelist companies are clearly getting ready for a slower amount of output in the second half of the year and possibly in the first quarter of 2024. They've got a good handle on the raw material coming in, as reflected by the fact that the manufacturing inventory number is extremely low. So they had, we've been able to work through this over ordering without a whole bunch of inventory and anybody's bucket, whether it be customer inventory bucket, manufacturing panelist companies bucket, or the suppliers buckets, although the suppliers ended up probably with the majority of the inventory compared to the panelist companies, but it can be used. And usually when inventory is held at the lowest level, there's more uses for it across a number of different products, as well as a number of different customers. So being able to liquidate that inventory at the supplier level is always the best thing, rather than have them move it up the supply chain where you have fewer and fewer outputs for it. So I think that's good. Revenue is probably down. Profitability is a huge concern. That's why we saw the employment number come down. We saw it come down a bit in June too. And that, the positive sign here too is not only are we resizing our factories and our headcount consistent with the reality, the new order level contracted again, but not as much as it did in June. And more importantly, we may have seen the trough of the new order level at 42.5 back in May. And then the backlog number is on the way back too. So I think all these things considered, you got prices still coming down, although there are some stuff that's up and down, which would indicate that you're in a transition period. We got lead times that are still way too long, but we can deal with lead times. You just end up making commitments that you may or may not follow through with. Okay, fine. That's not an unusual part of business. And so I'm hopeful that by the time we hit the fall here, meaning September, October, we're going to see that new order level get back up above 50, and we'll see the backlog number grow too. And that will signal that, okay, we're now back in an expansion cycle here in manufacturing, which would be good, I think, for everybody.
Do you think that timing has anything to do with this contraction mode that we're now in, or seemingly in, being that there's so many people that are on vacation for the first time in 3 or 4 summers? Does that have anything to do with the contraction? There's nobody around.
Well, I don't think we actually, when we ask the question, we don't really ask how many people are showing up to work. It's more about how many people are supposed to be at work. And then, we do a seasonal adjustment factor, which should take those things out.
Okay,
So, historically, last year we had quite a few vacations too. The year before that, we didn't. I think the seasonal factors are like a 5-year averaging or something. So no single year will outweigh it. But if you got artificial constraints for 5 years, it'll start to show up. But no, I think this is activity that says, okay, second half doesn't look good. We're going to make our profit plan. We got to make our cash flow plan. We're not going to make our revenue plan. So we got to cut costs. And the way you do that is you go back and fight with your suppliers about what you're paying for what they're selling you. And you either furlough people or you lay them off. I mean, furlough is usually something that is, or you attrit down or you freeze headcount. But those are usually early. When you look at the urgency of things, the first thing you do is you freeze. The second thing is you attrit down. The third thing you do is you lay off. And I guess the point here is that people aren't seeing the super urgency of laying off, which kind of says it. They've been preparing for this. They've been watching the indicators being new orders, order book, backlog has come down. They finally said, okay, we got to do something. Some of them are laying off, but generally the freezing and attriting is 2/3 of all the force managed activity. And that's what you would hope, because it gives everybody time again to adjust.
the problem with laying off, of course, is you put in all this time and effort to retrain or bring in new people and train them, which took you forever to be able to get new people in, the skill gap issue and retirements and so on. And now you're going to start to lay them off. I think the reluctance is, to your point, is not lay them off so quick. And to the point again, that's what you do last.
Yeah. And there's a couple things there. Attrition is kind of like the easiest, and there's no severance involved. Right.
Right.
And then when you're hiring like crazy, which we did, and we took, I'm going to exaggerate here. We took anybody that breathes and brought them onto the floor.
Right.
And during this frenzied hiring period, our success rate in terms of effective hiring had to be diminished significantly. So that, because we were taking people. So, let's call it a normal success rate of 75%. Meaning you hire 100 people, 75 of them are people you want to keep. We probably are more like the 60-65% in this cycle. Probably, layoffs are a good thing because you get to clean things up and you get to change attitudes. You get to start out with a new team and you get to keep the people you really want to keep. So, but we're not seeing a large scale amount of layoffs here. So nobody is seeing the urgency, and we're not seeing a huge amount of layoffs being announced, which means that nobody's taking severance charges, which are all good. It's all consistent with a soft landing, which is really defined as we're giving you time to right size yourself.
Right. And the summer is a good time to do that because typically it is a little slower in the summer months.
Yeah. And surprisingly, we still had a lot of people commenting about people quitting. There's still a significant amount of turnover at the factory level where people are leaving for other jobs. Now I would expect that that's going to slow. It has slowed, but it's going to slow further, I think. So, overall, the report really says, okay, we have different output expectations for at least the next 6 months, if not the next year. We probably think that the monetary policy has run its course and that there will be continual constraints put on us by the timing issue of higher interest rates. I don't think we're not expecting a huge amount of additional interest rate increases, which would kind of tank everything. The bank issue has gone away. There's no liquidity with the bank side. We burned off all the over ordering, so we're now back to a normal receipt of order. And matter of fact, we're probably going to accelerate it because we probably overreacted. and we're right sizing our factories. And there are indications that new order levels will start to come back. The negative piece, and if new order levels come back, the backlog will probably come back with it. The negative piece here is that the export market is not going to help us, and it's not going to help us for the rest of the year.
Right.
And that's 20% of manufacturing output. So China, Europe, a lot of negative comments on both. They're not. So we're going to have to, get ourselves out of this through our own domestic demand.
Yeah, China came out yesterday, the day before. Their GDP is looking really poor, and doesn't look like it's going to get much better. And actually now they're blaming us for their poor economy. We didn't help it for sure by imposing the Trump tariffs, but so be it. Meanwhile, it's us who's paying the tariffs, not China.
Yeah,
Right.
and there's a bunch of devaluation going on the RMB to kind of
Right.
offset that. The fact that China's even saying this is a surprise because they definitely manage their financial information.
Oh,
So-
absolutely.
Yeah, for them to say that they're slowing GDP, and their PMI is at 49, I think, for the month of July,
Right.
which kind of says they're stable. And it's been that way now for several months. I'm not so sure that's the case, but
What? You don't believe what they say? Oh, my goodness.
I spent a lot of time over there.
I as well at one point. Let's talk about some of the comments that your responders are putting out, just to sort of back up things that you've been saying.
Pick one.
Pick one. How about stable demand for the next 4 to 6 months, but longer term uncertain.
Yeah, most for sure. Remember the last couple of months we've been talking about everything is uncertain, everything. And uncertainty is a huge enemy of business. And I think at some point you have to draw the line and say, okay, this is what I know. And what I know is, here's my order book. Here's what my customers are saying. Demand is not going to come roaring back. This is one of the most unusual declines and recoveries we have ever experienced. So this is what I kind of know. It's like when I was in the business of vehicles. You always knew that equipment was going to wear out at some point. It was called the replacement demand. Then there's the growth demand. So you kind of cut into, okay, I know what the replacement demand is going to be. Meaning I got these units that are going to get close to the end of their useful life, or it's time for them to be sold. So I know I'm going to need to buy this many trucks because I got to replace them that are out there in the field. So that's kind of what they're looking at. All right, how much replacement do we have out there? You can kind of guarantee. And then what's the upside to that? And then so people have made all those back in May and June. They made those decisions as we reported out. July would be the reporting period. In some cases, August. Been listening to the analyst calls. They're very interesting. Profitability is still good. I think it's down maybe 10% quarter to quarter, but that's not bad at all. There's no serious amount of hurt here. There's not a lot of companies announcing large-scale layoffs and the reserves that go with that. So, I think we've right-sized the factories. We're right-sizing the headcount, consistent with our cultural ability to release people that we fought so hard to get. Demand is starting to come back a little bit. I'm hopeful in the next couple of months to see an over 50 new order number. And I think, what you'll probably see is the backlog follow that. The recovering the backlog number is going to be a little later because we consume so much of it that it's going to take some time to go ahead and see that backlog come up. And, with backlog coming up usually means people are looking to invest in capital and people. And so watch the backlog number. I think if you see that get above 50, we're in a growth spurt. In the meantime, I think we're in a trough. We're in a manufacturing contraction trough at 46 is not bad. Just go back and look. The last 4 or 5 months, we've been 47 to 46 for, I think, like 8 months. It's huge, but the sub indexes are moving. And now this month, I feel really good about where the sub indexes are. and supported by the other sub-indexes and what it means for the future.
One of your respondent comments I found very interesting, related to the miscellaneous manufacturing sector, where they stated sales remain higher than forecast, supplier capacity issues remain an issue. So the point that I'm pointing out is that the sales figures are higher than forecasted, meaning, to your point about where we are at with this report. So I'm going to paraphrase what you have said for the last 20 some odd minutes, is that in spite of contraction, we've got a great report.
Yeah, I think so. Well, right, because the number one enemy of manufacturing, of business, is uncertainty. And I think this report has given us some clarity. Not all the clarity, but it's given us some clarity. The first is that, okay, the factory output sales revenue is down, no big surprise. We're taking steps to reduce our headcount. Good. Let's not wait any longer. Demand is not expanding, but it's slowed its contraction, both new order levels as well as backlog. Customer inventory is about right. You know, it's in that about right level. Okay. It's not, it hasn't gotten to too high. It hasn't gotten to way too high, which is really good. And the export market is going to be pretty much a dud for the next 6 months. And then if you look at the input side, supplier deliveries are still faster, but they're better than they were the prior month. Slowly. Raw material inventory is probably troughed, which is good. That's been an unplanned headwind through all of this recovery, that we were able to get down to 44. And then you got prices still contracting, not as much as June, but still contracting, but maybe in that transitory phase. If it's in the transitory phase, then we're probably going to see the new order level increase, because buyers are going to jump back in and say, okay, I'm not going to look at $1,200 a short ton for steel. I'll go ahead and take your offer at $1,000 and place orders and build backlog. So, because I think a lot of lead time problems here, Lou, are related to mills. It's aluminum, smelting, it's steel mills.
Well, I'm glad you brought up about metals in the steel industry. Deliveries in metals is unusually long. Aluminum, 20-30 weeks. Steel, 20 weeks. The nickel alloys, the prices are higher than it's been for a very long time, and long lead times, and which of course is where my heart lies. And the pricing on those materials, the nickel, titanium, and the cobalt alloys, are much higher than where they probably should be.
Yeah, well, a lot of that's being driven by the EV side, and right. the anxiety around that. But you know these cycles. Usually what happens is we have a huge amount of demand. We place a huge amount of orders on the mills. They're reluctant to go ahead and expand, and they wait and they wait, and they finally expand. They reopen mills. By the time those mills get reopened, demand goes away. Right. They're stuck with all this capacity, and they're financially hurting, and they struggle. This time, it doesn't feel that way, which is kind of good. I don't like to see the steel industry on its knees for 2 years because they reopen new furnaces. I don't like to see that, and I don't like to see anybody get hurt in this. And usually the lowest person on the totem pole is the one who gets hurt the most. And in the case of mills, they're also the one with the biggest amount of capital investment. So that, they definitely have liquidity issues when they got plants that are 80% built and all of a sudden they don't have the revenue anymore. So I think this is helping them get through it too. Now, did the tariffs have anything to do with that? I don't know. I can't really say, but I don't like to see the primary metals market get hurt in any expansion and contraction. And generally they do, because of the lead times associated with standing up foundries and things. This time, maybe not, which is good. I feel good about that. They might survive this cycle.
Tim, great report. I'm with you on this. I really like it. I think this is great. I don't know how mainstream media is going to play this. They may play the, if it bleeds, it leads. But we'll see in tonight's news how it plays out. Tim, thank you very much for joining us today. And thanks for the great report.
Okay, you bet, guys. Good to see you, Lou. I'll see you in September. Have a great trip to the Cape. I'm heading there tomorrow on my motorcycle, by the way.
You're going where?
Cape.
Are you really? Where are you going to be?
My wife and I are going to Sandwich. That's where her sister lives and her brother-in-law.
That's not going to the Cape. That's going over the bridge.
Yeah. I know.
You have to go another 60 miles.
We were going to go to Provincetown, but we decided why go to Provincetown in August when we can go in September.
Well, I'm going to be there in October also. So if we'd like to get together,
Maybe we can connect.
You got my cell number.
That sounds good. You can take me out to lunch.
You bet. You bet. No problem. Have a good week.
All right. Thanks.
All right. Bye-bye. Okay, everyone. Thanks for joining us. We will see you next month. And we're also going to have Anthony Nieves in another 2 days, giving us the report on the services side of our economy. And they've been typically in recent months ahead of manufacturing. So we'll see how that number plays out. Thanks much for joining us. Bye now.
That's our show for today. Thanks for listening. If you enjoyed this episode and would like to support the show, please like and subscribe, share on social media, or leave a review. You can find us on YouTube, Spotify, Apple Podcasts, Google Play, Rumble, or your favorite podcast app. Visit us online at mfgtalkradio.com for our other episodes. We have also included links to our advertisers below. Thanks again, and we'll see you next week.